Okay, today we're going to talk about notes receivable. So remember, an accounts receivable is an informal agreement between two companies or a customer in a company where perhaps we deliver services or a small amount of goods and we expect to receive payment, or otherwise we would have not done business with them. With a notes receivable, typically we're talking about more money. And so it's important that we get things in writing. I'm sure some of you guys have seen Judge Judy before. And inevitably, the person that has nothing, no substantiation, is typically not going to end up, being the one on the winning side. Okay, so we want to have a formal note receivable. And this is going to strengthen the company's legal claim against those who fail to pay as promised. It also says down here at the bottom, and this is kind of the approach your book takes, that notes receivable are frequently accepted from customers who need to extend the payment period of an outstanding receivable. And notes receivables are also sometimes required of high-risk or new customers. We're not sure if they are, how creditworthy they are, and if they're likely to pay us. And once again, having all of this note receivable laid out is going to increase our likelihood of getting paid or having a stronger claim in court. Typically, these notes receivable are going to be interest bearing. So if we're letting somebody have an extended period of time to pay us, and we're talking about a substantial amount of money, we're going to want to charge them interest because we're not going to have use of the money during that time. And so in your book, that's going to be the way things are laid forth. There's going to be interest on all of these notes receivable. The maturity date of a note determines when it's going to be or where it's going to be placed in current assets or non-current. If we plan to receive any portion of it within the upcoming year or the current year, it should be treated as a current asset. And anything that we plan to receive further than a year out, we're going to treat that as being a non-current asset on the balance sheet. Feel free to pause the screen here if you'd like. This came from your book. But I think it's easier to just take a look at this slide here and to explain it using this. So in this case here, Pearl Land is the payee. They're the people that are going to receive this $2,000. Selig Company is going to be the one that's paying the $2,000. They're the maker. And so the face amount of this note is $2,000. And it's going to be paid in 90 days. Okay? And so we're going to also have an interest rate here of 10%. So you're going to see in a second, we're going to multiply the interest rate times the number of days that we have it. Actually, we're going to multiply it by the percentage this is of an entire year, because 10% is the interest we would have to pay, or they would have to pay us if they had this money for an entire year. But in this case, they just have it for 90 days. So what we're going to receive as Pearl Land Company from Selig Company, we're going to receive the $2,000 that they owe us plus the interest on top of that. So anyways, as we mentioned before, if a company needs more time to pay us, we might extend that amount of time, but we're going to make them put it in writing. We're going to charge them interest. So we are reducing our accounts receivable here, this asset, and we're increasing this other asset, notes receivable. So we're really trading one out for a more formal asset here. Now we're talking about $6,000 at a 12% interest rate. If we had it out for an entire year, we'd be getting 12% on $6,000, but we're only looking at 30 days. So when we receive payment, this is what we're going to get. We're going to get the $6,000 that they borrowed, or the $6,000 that they owed us, if you will, plus we're going to get the interest that we earned during that period. So we're going to get $6,000 plus 60, which is $6,060. If you're wondering how we came up with a 60 number, the first thing we did was we divided 30 over 360. Okay, so that's 1/12, 1 month out of 12 months. And notice here this says 360 instead of 365. In your book, we use what's called a banker's year, and this is just to make things a little easier for you to follow, but we assume that every month has 30 days. Okay, so this is 1/12 That's what that equals. So the easiest way to do it is to put that in your calculator first, then multiply it by 12%, which is 0.12. Multiply that by 6,000, and that's where you get the 60. So this plus this tells us how much we're going to get, or how much we received, how much cash on the 21st. But what if instead, so instead of this scenario, let's take a look if something totally different happened. So instead of them paying us at the end, what if they did not pay us? If they did not pay us, we're going to do just the opposite of what we did here a second ago. We're going to increase accounts receivable and decrease notes receivable. So you remember from earlier video earlier, we are going to write everything off based on what we have in accounts receivable. Right? So we look at those receivables, and when we aged them, we looked at how old they were, etc. So that's where we do all our writing off, not in the notes receivables, but we write everything off through our accounts receivables typically. So anyways, we're going to move this from being a note back to an accounts receivable. Now, while we let them have 90 days, and just think about it this way: during that time, or I'm sorry, what was it? 30 days? Yeah, it was 30 days, wasn't it? Let's go back here and look. 30 days. Okay, so during that 30 days, they had the money out. We earned this interest. They might not have paid us, but we actually earned it. So if they decided to pay us later, we're going to charge them the $6,000. In addition, we're going to try to collect that $60 that they agreed to pay us as well. Okay, hopefully that makes sense. You might want to take a break now, just for a brief second, to kind of clear things out in your mind, because now we're going to talk about a different scenario. So this section here of the video is going to discuss accounting for notes receivable that spans 2 accounting periods. So remember, we're trying to uphold the matching principle, and that states that we record, well, first off, accrual accounting states that we record revenue within the period that it is incurred, regardless of when we receive the cash. So that's based on the accrual basis of accounting. So what we're going to do here is we're going to look at a different scenario. This is a totally different company here. This is Crawford Company. Okay, and so we're going to take a look at Crawford Company. Same scenario. We're going to extend the period of time that they are going to have to pay us, and we're going to change this into a notes receivable. Now, notice this is December 1st, and we can assume we're a calendar year company here. So when we get to the end of the year, it's going to be on December 31st. So it's a 90-day note. 30 days is going to be in this year, and the remaining 60 days are going to be in the next year. So we're not going to get paid until the next year, but we've earned 30 days of interest in this year here. So in 2012, we would have earned 30 days, and in 2013, we would have earned 60 days worth of interest. So let's take a look here. So in year 1, right here, we earned 30 over 360, so that's 1/12, times 12% was the interest rate, times $4,000. So out of the 90 days, 1/3 or 30 of the 90 is going to be earned in year 1. We're not going to receive payment until way over here at the end of this month in year 2. So this is December, January, February. So at the end of February, we're going to receive payment. And when we receive payment, we're going to record that. You'll see that in just a second. But notice that we earned 2 years of interest in year 2. So anyways, we're focused on year 1 right now. And so our interest revenue was $40. That's what we earned. And we have what's called interest receivable. Now this is similar to an accounts receivable, but an accounts receivable relates to sales that we've made, and this has to do with interest that we've earned. So this is going to increase an account on the balance sheet, and this is going to increase an account on the income statement, which is revenue. Okay, so later on in the next accounting period when we receive payment, let's take a look at how it's going to work. they're going to pay us back the $4,000 interest, or I'm sorry, they're going to pay us right here the $4,000 of interest, the $40 of interest receivable, I'm sorry, from last year, and the $80 of interest that we earned this year. So that's $4,120 that they're going to pay us. This portion is what they owed us that they borrowed, so we're going to reduce that notes receivable. We're going to reduce this interest receivable that we just established over here, and this $80 is what we earned in this year right here. That pretty much sums everything up for now related to notes receivable. If you have any questions, please contact me. Have a great day.